acquisition and disposition of PP&E. We know what that is, right? Property, plant, and equipment. So we're going to look at acquisitions. How do we do that? What about self-constructed assets, including looking at capitalization of interest costs. Then we look at valuation of these assets. So like would be cash discounts. How do we handle those? Deferred payment contracts, stock issuances, non-monetary exchanges, contributions. Any costs subsequent to additions, acquisitions, like additions and improvements. So which costs would be capitalized, which costs would be expensed, and then the disposition of property, plant, and equipment. So property, plant, and equipment are assets, right, durable in nature, like machines, trucks, buildings, so forth. Other terms commonly used give your plant assets instead of PP&E, or fixed assets. They're used in operations, and they're not going to be used for resale. Not typically. Long-term in nature. Normally they're going to be depreciated, but not always. There's some assets like land that won't be. And then they possess some sort of physical substance. So they're a tangible asset, in other words. In general, when we record the value of a PP&E, a property, plant, and equipment, when we acquire property, plant, and equipment, you normally use historical cost. So it measures what we paid for it, for the asset, as well as bringing it to the location, transportation costs, and then getting it to condition necessary for use. So all those are costs that we can use in capitalizing our asset. So why do we use historical costs? Well, it's reliable. It's easy to find. It's information is easy to find. And then the second reason, companies should not anticipate gains and losses, but should recognize gains and losses only when the asset is sold. All right, so in other words, we won't take, even if the asset's gaining value, we won't report any unrealized gains on the asset until the asset is sold. All right, cost of land. So all expenditures to acquire the land and get it ready for use. So typically these costs, purchase price, what we're going to pay for it, closing costs, so title, attorney's fees, recording fees, those types of things. Then any grading, filling, draining, and clearing the land if that's needed. Assumptions of liens, mortgages, or encumbrances on the property would be part of the cost of land, and sometimes it'll happen, or we may have to pay some taxes on that land in order to take ownership of it. All right, and then additional land improvements that have indefinite life can also be part of the cost of the land. Now, improvements with limited lives, such as a driveway or walkway, fences, parking lots, are recorded as land improvements, and those are depreciated because they have a limited life. Now, if I acquire land and held for speculation, meaning I'm acquiring it as an investment, hoping it's going to gain money next 5 years, then we can classify that as an investment. Land held by a real estate concern, real estate agent, real estate entity for resale should be classified as inventory. So if that's their business, is selling land, then they can classify that land as inventory in their business. All right, acquisition of PP&E, cost of building. So all expenditures related directly to the acquisition or construction of the building should be included in the cost of the building. Those include material, labor, overhead during construction, and then any professional fees, building permits, those types of things. If we have those expenditures can be capitalized to cost of the building. All right. For equipment, any costs in acquiring the equipment, so purchase price, along with costs in preparing it for use in the business. So those include price, freight, handling, insurance, any costs of, say, special foundations, assembling and installation costs, and costs of conducting trial runs. All those could be capitalized, or would be capitalized as part of the asset. All right, so this is just a little quiz, but you don't have the answer, so it's not a big deal. Expenditures and receipts below are related to land improvements and buildings acquired for use in a business enterprise. Determine how the following should be classified. Money borrowed to pay the building contractor. Well, the money borrowed was the note, right? Note payable. So we record the money borrowed as a note payable. Payment for construction from the note proceeds would be for the building. Cost of landfill and clearing as part of the land. Delinquent taxes on property assumed. So sometimes we have to do that. And taking possession of the land. So that would be a charge to the land. Premium on a 6-month insurance policy during construction. So we're building the building ourselves, and we have a 6-month insurance policy. We can charge that insurance policy to the building. We don't have to charge it to insurance expense. We can capitalize it, and according to GAAP, we can charge it to the building. We refund part of it back, though. We need to reduce the amount that was capitalized as part of the building. Here's a few more. Architect's fee on building would be charged to the building, can capitalize to the building. Cost of real estate purchased as a plant site, land of $200,000 and building of $50,000 would be land. And you're wondering, well, why wouldn't we charge part of it to building or allocated? Because it looks like, I'm just assuming from this, that the building's going to be torn down. We're going to have a new plant site. And we pay for the building that's on there already on the land, but we're not going to use the building. So that all goes to land. Commission fee paid to real estate agency would be land. Installation of fences around our property would be a land improvement because they do not have an indefinite life. Cost of raising and removing the building would be part of land. So that would be charged to the charge of that, right, would be charged to land. Proceeds from salvage of demolished buildings. So we got some cash from that. We got some wood that we sold or copper. We can reduce them. We reduce the capitalized part of the land. The previous NK, right, part of that was used for land, but we got $10,000 track. We have to reduce the amount capitalized to the land by the $10,000. Parking lots, driveways, street lights, all those types of things are land improvements. Trees and shrubbery, and they're permanent, right? They have indefinite lives, and those would be charged to the land. Many organizations will self-construct their own plants, their own assets. So the cost, of course, will be material, and then a direct labor, and then overhead. We can either assign no overhead or assign a portion of all overhead to the construction process. Normally companies will assign. There is going to be overhead, so they will assign that to the construction process, and it'll be capitalized. All right, so 3 approaches have been suggested to account for the interest incurred in financing the construction. One is, hey, no capitalization of interest allowed. The second approach, and this is a gap, capitalize actual costs incurred during construction. And then the third is capitalize all cost of funds. They don't let you do that. But there is a portion of your interest costs that you can capitalize and still be in compliance with GAAP. All right, so interest costs during construction. So GAAP requires capitalizing actual interest with modification. We'll see that in a minute. Consistent with historical cost, consider 3 things. One, it's qualifying asset. All right, so it's something that's property, plant, and equipment. There is a capitalization period. It's 3 months, 6 months, 12 months. And then there's a dollar amount that we can capitalize. All right, so qualifying assets require a period of time to get them ready for their intended use. 2 types of assets. So assets under construction for a company's own use, and then assets intended for sale or lease that are constructed or produced as a discrete project. So that's more like an inventory thing, right? But the first one, assets under construction for a company's own use, we can capitalize at least part of the interest on that. All right, so capitalization begins when expenditures for the asset have been made. So that's first time you make an expenditure for that asset you're building, that's when the capitalization period starts. Activities for writing the period should be in progress. Interest costs are being incurred. All right, so it ends when the asset's complete, right? Substantially complete and ready for use by our employees. All right, so interest costs during construction. So we capitalize the lesser of actual interest cost or avoidable interest. So what's avoidable interest? Amount of interest cost during the period that a company could theoretically avoid if it had not made expenditures for the asset. All right, so let's look at this example illustration of interest capitalization. So assume a company borrowed $200,000 at 12% from State Bank on January 1, 2017 for specific purposes of constructing special purpose equipment to be used in its operations. Construction on the equipment began on January 1, 2017, and the following expenditures were made to the product's completion, which was on December 31. So we had expenditures of $100,000 on January 1, $150 on April 30th, another $300 on November 1, and $100,000 on December 31st. And then we have some other debt outstanding not related to the building that we're building. But we have $500,000, 14% 10-year bonds payable, and a 3-year, 10% 5-year notes payable. So determine which assets qualify for capitalization of interest. Special purposes equipment qualifies because it requires a period of time to get it ready and be used in the company's operations. So we know it's specifically special purpose to our operations, to our making of our product. So that would be one that can be capitalized. Then determine the capitalization period. So for this company, it's going to be 1 year because they started January 1st, finished December 31st of 2017. All right, then interest cost, we use a weighted average interest cost. So I have expenditures of 100,000 and we're funding this, right? So because it was January 1, we get to capitalize it for 12 periods. We spent 150 on April 30th, so that's only 8 months. So we don't get to record the full amount of interest. And then November 1, so that's only 2 months. And then this one on December 31st, we can't take any interest. And we can't capitalize any interest on that one because it didn't happen until the end of the year. All right, then compute the actual and avoidable interest. So selecting the right interest rate. So for the portion of weighted average expenditures that is less than or equal to any amounts borrowed specifically to finance construction of the assets, use the interest rate incurred on the specific borrowings. So borrowed 100,000, 12%. Use those specific interest rates for those specific borrowings. For the portion of weighted average committed expenditures that is greater than any debt incurred specifically to finance construction of the assets, use a weighted average of interest rates incurred on all other outstanding debt during the period. All right, so step 4. So here's our actual interest and avoidable interest. So the amount of actual interest for the project is $24,000. $200,000 was the specific debt at an interest rate of 12%. So $24,000 was the amount of actual interest. And then our general debt stuff, not related to our capitalization, we had 14 and 10. So weighted average rate, we said to find a weighted average rate on the general debt. If you're looking for a rate, you can't find one. So there's $100,000 in interest, 70 plus 30, and we divide by 800,000, divide by the 800,000 total debt. So 12.5% is our weighted average interest rate. All right, then the avoidable interest is going to be, we're going to use this 12.5%. All right, and it's the amount by which the weighted average accumulated expenditures exceed the construction loan. So the loan was 200,000. We had other expenditures of 50, so 50,000 exceed the loan. We'll use a weighted average rate of 12.5%, and we can record that as avoidable interest, $62.50, along with the $24,000, right? That we basically is tied to that special purpose asset, the 12%. This bond or note was for that 12%. All right, so the interest, avoidable interest is $30,250. And journal entries will debit equipment $32.50 and credit interest expense for $32.50. Some special issues related to interest capitalization. If a company, for land, if a company purchases land as a site for a structure, interest costs capitalized during the period are going to be charged to the plant. So sometimes people find that a little surprising, that one. So you're purchasing land, but actually you're going to charge him the interest amount, capitalize it to the cost of the plant. Conversely, if the company develops land for lot sizes, it includes any capitalized interest costs as part of the acquisition cost of the developed land. All right, then interest revenue in general, we should not offset interest expenses and interest revenues by each other. So they should be separate and looked at separately. All right, so companies should record property, plant, and equipment, fair value of what they give up, or the fair value of what they received, whichever is more clearly evident. So here's some issues that come up in valuing your PP&E cash discounts. So, if you're buying a machine and pay it in 10 days, and say you get prompt payment, so that's a cash discount. So that would be part of the, well, I guess it would reduce the amount of capitalized asset, amount of capitalized machine. Deferred payment contracts, assets purchased on long-term credit contracts at the present value of the consideration exchanged. So for deferred payment, so we're going to pay 1 year from now, and then 2 years from now, 3 years from maybe an annuity. So we find the present value of those amounts. Lump sum purchase, allocate the total cost among the various assets on the basis of their relative fair market values. And then issuance of stock, market price of stock is issued as a fair indication of the cost of the property acquired. Exchanges of non-monetary assets ordinarily accounted for on the basis of the fair value of the asset given up or the fair value of the asset received, whichever is clearly more evident. We talked about it a minute ago. Companies should recognize immediately any gains or losses on exchange when the transaction has commercial substance. Now, how can you tell if an asset has commercial substance? All right. So if future cash flows probably more likely increase, right? As a result of the transaction, then we say that it has commercial substance. So thus, the two parties' economic positions change. Gets better than transaction has commercial substance. All right, so if it has commercial substance, then all gains and losses recognized immediately. If it lacks commercial substance, no cash, defer gains, but recognize losses. Then if the exchange lacks commercial substance but cash is received, you will recognize partial gain based on the cash you received. So that amount of cash received will allocate a portion of that cash received to the gain. Exchanges, the loss situation, normally going to recognize that loss immediately, whether or not there's commercial substance or not, and partly that's due to conservatism. Also, we should not value assets at more than their cash price, so we don't have a lower cost to market, right? Losses were deferred, assets would be overstated. All right, so here's a couple of some examples of exchanging assets. So Information Processing Inc. trades its used machines for a new model at Jared Business Solutions. The exchange has commercial substance. The used machine has a book value of $8,000, so it had original cost of $12,000, less cumulative depreciation of $4,000, so a book value of $8,000. Fair market value is $6,000. New model costs $16,000, but Jared will give you a trade-in allowance of $9,000 for the used machine. So information processing computes the cost of the new asset as follows. So I got price of the new machine of $16,000, less the trade-in allowance of $9,000, so cash payment due is $7,000. Take my cash payment due, add fair market value of $6,000. That's my cost of my new machine. So $13,000 will be the cost of my new machine. So I'll debit equipment for $13,000. Get the old cumulative depreciation. There's a cumulative depreciation of $4,000 on the books, right? $4,000 left. So I'll debit cumulative depreciation for $4,000. My equipment that I'm getting rid of costs $12,000. Original cost of $12,000. All right, and our cash payment was $7,000, and the loss is $2,000 because the fair market value of this asset is $6,000. Book value of the used machine is $8,000, so I've got a loss on disposal of used machines of $2,000. All right, if it has commercial substance, as I mentioned, that record the non-monetary asset in exchange for another non-monetary asset at fair value of the asset given up, and then immediately recognize gain at this point. So the Interstate Truck Transportation Company exchanged a number of used trucks plus cash for a semi-truck. The used trucks have a combined book value of $42,000. It cost $64,000, but there's $22,000 accumulated depreciation. Interstate's purchasing agent experience in the second-hand market indicates that the used trucks have a fair market value of $49,000. In addition to the trucks, Interstate must pay $11,000 cash for the semi-truck. Interstate computes the cost of the semi-truck as follows. So fair value of the trucks exchanged, $49,000 fair market value. And then cash paid is $11,000, so $60,000 would be the cost of my semi-truck. All right, so here's the transaction. We can debit truck for $60,000, accumulated depreciation goes off the books at $22,000. We credit trucks for $64,000. We did have a gain of $7,000 on the disposal of the trucks. That's shown here, right, that we had fair value of the trucks of $49,000, book value is $42,000, so $7,000 is the gain on disposal. All right, now the situation where it lacks commercial substance, no cash is received. Interstate defers again at $7,000 and reduces it on the basis of the semi-truck. So we record the transaction as follows. We'll debit trucks, $54,000, that's our new one. Debit accumulated depreciation trucks of $24,000. We'll credit trucks for $64,000 and credit cash for $11,000. So down here shows you that the fair value less gain deferred give you $50,000. Book value of trade here plus cash paid is what, $53,000. Book value of used trucks. So either way, it gets you to the basis of $53,000. What's going on, of course, is the $7,000 gain is being deferred. Now, as mentioned earlier, if it lacks commercial substance, in general, no gain or losses should be recorded. But if we receive cash, then we should record a portion of the gain related to the cash. So here's an illustration. Santana Company exchanged equipment used in its manufacturing operation, plus $2,000 in cash for similar equipment used in Delaware. Following information pertains to the exchange. So Santana gave up $28,000 worth of equipment. They had $19,000 human depreciation. Fair value is $13,500. Just a second. A dog found a squirrel or something. All right. So Santana exchanged equipment used in manufacturing plus $2,000 in cash for similar equipment used in the operations of Delaware. Following information pertains to the exchange. So Santana, $28,000 of equipment. Cumulative depreciation was 19. So this is what Santana's given up. Fair value of that equipment is 13,500, and then the cash at 2,000. So they'll report a gain based on this portion of cash of 2,000. We'll see how that works in a minute. And then Delaware gave up 28,000 in equipment, 10,000 in cumulative depreciation was written off, and then their fair value was 15,500. All right, so Santana, fair value of equipment received was 15,500. They paid 2,000. And they had equipment depreciation 19, right, less 28. So they had a book value of 9,000 on their asset. Okay, so we have 15,000, and we'll subtract then that 11, so 15,500 minus 11,000. So this is our gain for Santana was 4,500. On the other hand, Delaware took a loss, so they had 13,500 in fair value. They did receive 2,000, but their book value was worth 18,000. The equipment they gave up, so their loss was 2,500 on the exchange. And then you'd make your entries. Now, Santana was saying has commercial substance, and of course there's also cash. So you can record, your gain if there's, well, it has commercial substance, so normally then you would record gain or loss anyways. All right. For Santana, this one lacks commercial substance, so we have equipment. They paid cash and received cash, but they paid cash. So their equipment is 15,500. So we're going to record it for 11,000, reducing it by the $4,500 gain. Cumulative depreciation would be debited for 19,000, credit cash for 2, and credit equipment for 28. So showing these two transactions for Santana with commercial and lacks commercial, notice that the difference is that when it has commercial substance, we're going to record the gain, and if it lacks commercial substance, the gain will be deferred, and the amount of the equipment will be capitalized at 11,000. So we will subtract out the gain from the 15,500, record a smaller amount of equipment. All right, then here's Delaware. The first one, we're assuming it does have commercial substance. So they had debited cash, received 2,000, equipment 13,500, cumulative depreciation of 10,000. So we're 2,500 short here, and that's going to be charged. So we can kind of use a gap figure when doing this. When I did these problems in college, I would work these out, get all the debits and credits I knew. Normally your loss or gain can be a plug. So in this case, the loss of 2,500 would be debited, to be a plug, and then the 28,000 could have been credited. All right, and then down here, lacks commercial substance as well. It lacks commercial substance, but it's going to be the same entry as above because we received cash. So if we receive cash, you can show partial or full gain or loss on disposal of the equipment. All right, sometimes companies will contribute things, and when contributing, accounting for contributions, fair value of the asset should be used, and should recognize contributions received as revenues in period received. So, Max Wire Meat Packing Company, recently accepted a donation of land with a fair value of $150,000 from Memphis Industrial Development. In return, Max Wire Meat Packing promises to build a plant in Memphis. So that's revenue. They got $150,000 because they're going to build a plant for them. So we'll debit land and we'll credit contribution revenue. So when a company contributes a non-monetary asset, it should record the amount of the donation as an expense at the fair value of the donated asset. Klein Industries donates land to the city of LA for a city park. Land costs $80,000, has a fair value of $110,000. Klein Industries records its donation as follows. So we debit contribution expense for $110,000. We'll credit land because it's gone $80,000. But notice here, this is kind of funny. Even though we're reporting expense, we have to report the gain on the disposal of land. The land is worth $110,000 and it only costs $80,000. So we got to report this gain on disposal of land for $30,000. Okay, which is interesting because they're recording on a gain on a transaction that's an expense. All right, costs subsequent to acquisitions. These are things like improvements and so forth. In general, those are going to be capitalized. Although if there are some that just are providing maintenance, like painting, so forth, those will be expensed. So in order to capitalize, one of three conditions: useful life must be increased, quantity of units produced must be increased, quantity of units produced must be enhanced, so higher quality product. So this is just a summary of what happens to those costs subsequent to acquisition. So additions, improvements, replacements, for those in general, they're going to be capitalized. So we capitalize costs of improvement and replacement. Rearrangement and reinstallation, same thing, that in general, they're material in amount and benefits, future benefits. Then we can capitalize it as an asset. All right, and then repairs, ordinary repairs, just expense, major, as appropriate, treat as an addition, improvement, or replacement. So just kind of an overview of those items. I think there's probably more detail in the chapter in the homework. Company may retire plant assets voluntarily or dispose of them by sale, exchange, conversion, or abandonment. Depreciation must be taken up to the date of disposal. So Barrett Company recorded depreciation on a machine costing $18,000 for 9 years at the rate of $1,200 per year. If it sells the machine in the middle of the 10th year for $7,000, Barrett records depreciation to the date of sales. How much? Okay, well, you record depreciation on a machine costing $18,000 for 9 years, a rate of $1,200 per year. And we're going to sell it in the middle of the 10th year. So, first of all, we record depreciation to the date of sale. We'll debit depreciation expense for $600 credit accumulated depreciation for 600. So 1,200 a year, right, is the depreciation, and was for half a year. So you will go ahead and report that depreciation expense for those 6 months. All right, now we're going to go ahead and take this machinery off the books. So I received cash, 7,000. Accumulated depreciation on those old machines was 11,400. Is almost fully depreciated. Machinery, then we can credit for the 18,000 cost, and then we end up with a gain of 400. So if you were to, if this was the last one you to put in, you'd see you're off by 400, and that's normally how that works. That can be plugged in. Involuntary conversion, so some type of fire, flood, theft. Companies report the difference between the amount recovered from insurance and so forth, and then the asset's book value as a gain or loss. And they treat these gains or losses like any other disposition that you might have in your company, so not treated any differently. So here's another example. Camel of disposition. Camel Transport had to sell a plant located on company property that sold directly in the path of an interstate highway. For a number of years, state sought to purchase land on which the plant stood, but the company resisted. State ultimately exercised its right of eminent domain, which courts upheld. In settlement, Camel received $500,000, which substantially exceeded the $200,000 book value of his plant and land. Cost of $400,000, but accumulated depreciation was only $20,000. So here he is, Camel making the final entry. So we'll debit cash for $500,000 received, and we'll debit accumulated depreciation, plant asset, for the $200,000. And then we credit plant assets for $400,000, and then a gain disposal for $3,000. All right. So 500,000 less the 200,000, right? What you received versus what you accumulated. So 2,000 greater than 3,000. All right. If I can answer any questions, I will. Can't do it here, but you have my email and you have my phone number. So give me a call. Study hard for the exam. And I guess I should mention that the exam is 22nd, same window, like 3 to 9. And then your final, I think, is August 1st. All right, you guys have a great day. Thank you.